We all are very fortunate people. We, as in you and me, citizens of this great country. We are fortunate because we are citizens of this great country, and very, very fortunate that we are citizens at this point in time in the history, where our country is making progress in leaps and bounds. Friends, welcome to this session. My name is Deepak Mehta. I'm the head of strategic alliances at UTI Asset Management Company Limited. India is recognized as a nation of savers. The saver mindset has gradually culminated into an investing one. Today, Indian mutual fund industry boasts of an asset under management of over 41.5 lakh crore rupees. 41.5 lakh crore rupiah Indian mutual fund industry manages. Over 15.5 crore folios. Each month, almost 18 to 20 lakh new SIPs are being added by this mutual fund industry. Total live SIPs of over around 6 crores, adding 12,000 to 13,000 crore rupees each month to Indian mutual fund investing, Indian mutual fund AUM. But all this journey, this investing journey, when did this start? The start of this journey actually happened in 1964, when Indian Parliament, as an act of Parliament, established Unit Trust of India in this country. Unit Trust of India, now in the new avatar as UTI AMC, is the pioneer of mutual fund business in India. Today, UTI AMC, in its current avatar, manages over 15.5 lakh crores of investor money across various businesses, mutual funds, alternative investment funds, retirement business, and portfolio management services. We enjoy the trust of our investors. Professionally managed, listed company, board-driven, with no identifiable promoters. Known for its investment products, unique investment products, robust investment processes, and risk management. And that is the reason we enjoy the trust of over 1 crore investors in this country. While the craze for passive investing, or index investing as it is popularly called, looks quite new, you will be surprised that UTI AMC launched its first passive fund some 23 years back. Yes, 23 years back, we started our journey of passive investing. UTI today manages around 90,000 crores of index fund and ETFs, as in passive investing. UTI's passive products are popular because of maintaining the tracking error, as it is called in passive investing, at the lowest levels in the industry. And that is the reason we are very popular. UTI's Nifty Index Fund is over 10,000 crore fund. We have, besides the normal index fund or the passive investing, have also been very active in Smart Beta Index category. What is Smart Beta Index category? Smart Beta Index category is a category which is, while being a passive investment, enjoys all the benefits of passive investment, but it also draws a lot of advantages of active investing. So, best of both the worlds. In Smart Beta Index funds, we have launched various innovative solutions for our investors. We have a UTI Nifty 200 Momentum 30 Index Fund in the Momentum category. We have UTI S&P BSE Low Volatility Index Fund in the Low Volatility category. We have UTI Nifty Midcap 150 Quality Fund in the Quality category. We have UTI Nifty 500 Value 50 Index Fund in the Value category. So we have various Smart Beta strategy products for our investors. In the same series, we have now come up with 2 new products: UTI Nifty 50 Equal Weight Index Fund and UTI S&P BSE Housing Index Fund. Today's call is more focused on UTI Nifty 50 Equal Weight Index Fund. What is UTI Nifty 50 Equal Weight Index Fund? Why and who should invest in this fund? What are the advantages of all this new category which we have introduced? To talk all about that, I have my colleague with me, Sharvan Goyal. Sharvan Goyal is a fund manager and head passive arbitrage and quant strategies at UTI AMC. Experience of over 17 years, CFA charter holder from USA and an MMS from Bombay. He has a lot of experience in risk management, equity research, portfolio analysis, and he manages almost 12 schemes across various passive strategies in equity gold portion of as well as UTI multi-asset fund and arbitrage fund. Sharvan will go through a presentation for a couple of minutes. Once his presentation is done, we'll be happy to take your questions and address any kind of queries which you would have. So without taking much time, I'll now invite my dear friend, Sharvan Goyal. Over to you, Sharvan.
Thank you, Deepak, for setting the tone of the presentation today. You have nicely described advantages of passive funds. So you have also alluded to various smart beta strategies that we have launched in the last couple of years, and most of these strategies have delivered good returns to the investors. So today we have come up with a product which is simple but effective smart beta solution based on equal weight being a factor. Most of you are aware about the benefits of Nifty 50 index, wherein Nifty 50 index captures 50 largest companies, which are also most liquid blue chip companies listed in India. These 50 companies have gone through different business cycles, and they have stood test of time. And these 50 companies by nature are the barometer of Indian equity markets. The construct of Nifty 50 index is based on the size of the company. So top 50 companies listed on NSE, the weighing criteria is based on the relative size of those companies in the index. So for example, the top 10 companies within Nifty is having about 58% aggregate weight, while remaining 40 companies are having remaining 42% weight in Nifty 50 index. While we have come up with a simple but simple yet effective smart beta strategies, which is exploiting equal weight as a factor, wherein equal weight is assigned to all 50 companies which are part of Nifty. So we will talk about this particular product in the subsequent slide, but let me just refer to the passive investing, key advantages of passive investing, growth of passive investing in India in last few years, at the same time what UTI is offering in this space. So first and foremost, the key question is, what is passive investing? So in case of passive investing, objective is to hold same securities in the same proportion as the underlying benchmark, with an objective to deliver returns which are identical to the benchmark, subject to tracking error and cost of the fund. In case of passive investing, aim is to deliver similar return as underlying benchmark. And this particular portfolio, just like Nifty 50 or any other passive funds, is rebalanced on periodic basis. So for example, Nifty 50 index is getting rebalanced on half-yearly basis. So every year, end of March and September, this particular portfolio is getting rebalanced. Passive funds are also called beta trackers, because aim of passive funds is to replicate the benchmark without targeting to outperform these benchmarks. So which means if you are investing in passive fund, then your returns would be very close to the benchmark return. There could be two types of passive investing from the way you are investing, that is index fund and ETFs. From broad fund management perspective, both ETF and index funds are same, which means both ETF and index funds are holding same securities and in the same proportion as benchmark, but the way you are investing is different. While in case of index fund, investment in index fund is just like investment in any other mutual fund schemes, wherein you are investing before cutoff time, which is 3 p.m. for equity schemes, and you are getting day and NAV. So index fund category is very simple for investors because most people are aware about the nuance of investing in mutual fund industry. While investment in ETF is similar to investment in stocks. You have to invest through secondary market, the way you are investing in stocks. So people who wants to take advantage of intraday price movement, they could prefer investing in ETF. But for investment in ETF, you need demat and trading account, And whenever you are investing in passive in ETFs, you should be aware about the overall cost of ownership, because apart from expense ratio charged by the scheme, you have to also bear demat and trading account charges and any other associated cost of buying through secondary market. UTI as well as mutual fund industry is offering wide bouquet of product within passive funds. So apart from broad market cap based indices such as Nifty, Sensex or Nifty Next 50, most of the fund houses are offering various categories of thematic and sector funds, wherein you can invest in certain themes which you are bullish on. So for example, we have launched BSE Housing Opportunities Fund recently, wherein NFO is also going on. And then you can also invest in certain sectors wherein you are bullish. So for example, Nifty IT Index, Nifty Bank Index, Nifty Healthcare Index. At the same time, as Deepak also alluded, a lot of smart beta strategies which are trying to exploit certain performance factors have also become very popular in recent times, which are trying to exploit certain performance factors in an attempt to outperform the benchmark or to get the desired result. For example, in case of low volatility index fund, the objective is to reduce the volatility of the index and to get the smoother returns across the journey of the investment. So in India, we have seen phenomenal growth in passive funds industries AUM. Size of the passive fund industry was about 14,000 crore in March 2015. And in just about 8 years, there has been almost 40x growth in mutual funds, passive funds AUM. And it has grown from 14,000 crore to over 7 lakh crore in just about 8 years time. Similarly, in the similar time framework, it has grown from just about 1% of mutual fund industry to almost 17% of mutual fund industry. We have seen phenomenal growth in passive funds AUM growth globally, especially though most of the developed countries wherein size of the passive have become bigger than active funds. At the same time, last couple of decades, passive funds are getting lion's share of inflows within mutual funds across the globe. So because passive funds are simple to understand, these are available at low cost. So because of these inherent advantages, we have seen phenomenal growth in passive fund industries AUM in last few years. So what are the benefits of passive investing? The first and foremost is simple yet effective. So passive funds provide simple yet effective investment solution to generate market returns. So if you are investing in a Nifty based index fund, then you know that Nifty comprises of 50 largest companies which are traded on NSE, and these 50 companies will give you 55% of market exposure based on aggregate market cap that these 50 companies are capturing as compared to overall listed companies universe. The good part about Nifty is this has stood a test of time, and these broad market cap based indices are easily understandable. And people who are new to investing, they should ideally start with simple to understand broad market cap based index such as Nifty, Sensex or Nifty Next 50, because asset allocation plays far bigger role in long-term wealth creation, and one should start their journey with simple to understand passive funds. As you get aware about the nuance of some technical funds such as smart beta or thematic fund, then you can start investing in those kind of complicated product. But one should start with simple to understand broad market cap based index fund. Second biggest advantage of passive fund is these passive funds are available at low cost, because passive funds objective is to replicate the benchmark. So at fund house level, a lot of research is not available. At the same time, it is getting distributed much more effectively. So because of that, cost structure is much more superior for passive funds, and these passive funds are available at fractional cost of active funds. So the lowest cost passive funds is 5 to 7 basis point for broad market cap based ETF, while some of the broad market cap based index funds are available about 20 to 30 basis point cost. So these are available at low cost, and in the long run, low cost matters a lot, because money saved is money earned, and compounding at 1-2% higher creates a lot of wealth in the long run. Third factor is passive funds avoid psychological bias. So active funds take decision based on certain philosophy that particular fund is following. So because of that, it is impacted by the human biases of the fund manager or the philosophy of the fund. And at times, that philosophy may or may not work out in the favor of the fund. So because of that, there is a high variation in active funds performance. So because of this, passive funds provide identical return to the benchmark, and they are not exposed to these market risks. Fourth is mutual fund industry is a tax efficient industry wherein mutual fund schemes are exempt from tax. So which means whenever mutual fund schemes are booking any profits, either long-term or short-term capital gain, or either by way of receiving dividend income, in that case, mutual funds are not liable to pay any tax. So which means that if you are staying invested in any scheme for 10-year period, so you are not paying any tax, or even indirectly through mutual fund. So whenever you are booking or realizing gain, maybe after 5, 10, 15 years, at that time you have to pay long-term capital. So we at UTI are offering wide bouquet of products. So apart from broad market cap based indices such as Nifty, Sensex, Nifty Next 50, which are available both in ETF as well as index fund category, we have also launched smart beta funds across the broad factor-based strategies such as momentum, low vol, quality, value, and we have also come up with Nifty equal weight index fund, which we are going to talk about today, and as well as BSE Housing Opportunities Fund. And apart from that, we have also commodity-based ETF and FOF. At the same time, we also have 4 or 5 products on that category as well. So we have wide bouquet of product across different asset classes such as equity, fixed income, as well as commodities. So what are the advantages of investing in UTI index fund? UTI, as Deepak also alluded, that we at UTI are pioneer in passive funds in India. We have launched UTI Nifty Index Fund 23 years back, and UTI Nifty Index Fund is the largest and oldest index fund in the category. It is having 10,000 crore AUM, which is largest in the industry. In fact, it is the only 10,000 crore category, 10,000 crore fund in the index fund category. At the same time, the overall passive space, we are managing close to 90,000 crore worth of AUM. So we are one of the largest player in passive space, and in index fund category, we are the largest. At the same time, we are managing our passive funds in a very effective manner. So in terms of tracking error, which is the performance criteria for judging performance of any passive funds, we are having one of the lowest tracking error across different categories and across different time frame. Because of sheer size and focus on passive funds, we have developed systems and processes in such a way that we are able to replicate the benchmark much more efficiently as compared to most of the peers. So we are using tools, systems, and processes which are used by global money managers, so which is helping us replicate the benchmark much more effectively as compared to most of our peers. At the same time, our funds are priced very competitive as compared to industry. So we are very competitive in terms of expense ratio. At the same time, performance track record is also far superior. So now today, we will talk about UTI Nifty Equal Weight Index Fund. So before starting this, let me share my thoughts on reason behind success of a cricket team, which is a team game. So cricket fans around the globe were hooked up to their TV screens during recently concluded IPL series, wherein most of the matches, including the final, went right down to the wire. And Chennai Super King, CSK, led by MS Dhoni, won the coveted trophy. The well-balanced Chennai team has won the trophy for the 5th time. At the same time, they have played in the finals 10 out of 14 series, and 12 out of 14 times they have qualified for the playoffs. So they are one of the most consistent and good performing scheme within IPL. What is the secret source of good performance of CSK or Chennai Super King in the IPL series in the last 14 years? The Chennai Super King team is very well balanced, and each and every member of the team is contributing to team success. And because of this, they are able to consistently perform well, while some of the other star-studded teams are unable to consistently perform well in the IPL series. So the secret sauce of performance in any team game is well-balanced team, which means each and every team should be ready to contribute in the team success. Inspired by this thought, we have launched a product which is following similar strategy, wherein equal weight is assigned to all 50 companies which are part of this index. So which means that we are giving equal importance to all the companies which are part of this fund. Unlike Nifty 50 index, wherein top 10 companies are having about 58% weight, which means that the importance of top 10 companies is much more in case of Nifty, while because we are assigning equal weight at the time of rebalancing in case of Nifty 50 equal weight index, each company plays equally important role in the success of this particular fund. So let us analyze the key features of this index fund. First and foremost, all the constituents which are part of Nifty are also part of Nifty 50 equal weight. So which means that stock selection is same as Nifty. The only difference is the weighing criteria is different. So here we are applying alternate weighing criteria, while in case of Nifty 50 index, companies are having weightages based on relative size of the company in terms of free float market cap within Nifty 50. While in case of Nifty 50 equal weight, all the companies, all the 50 companies are having equal weight, which is 2% at the time of rebalancing. This particular index is getting rebalanced on a quarterly basis. So every year, end of March, June, September, and December, this particular index is getting rebalanced. This quarterly rebalancing feature has actually contributed to good performance of this index. Because in case of quarterly rebalancing, companies which are performing relatively better as compared, so which means at the time of rebalancing, to make it equal weight, we are booking profit in the companies which are performing better as compared to other companies, while auto averaging companies wherein weight has fallen because those companies have underperformed during the quarter. So this auto profit booking and auto averaging at the time of rebalancing has contributed to the success of this fund. So just to give you one illustration, which we have analyzed in last 5 years. So for example, we took the weight of, we took Nifty 500, Nifty index 5 years back. We assigned equal weight for all those 50 companies 5 years back. And we allowed that index to run for 5 years. Then we run another iteration wherein we are doing rebalancing on quarterly basis. So which means on quarterly basis, companies which are delivering better returns, we are booking profit in those companies while buying companies which have underperformed during the quarter. So because of this auto rebalancing feature, wherein we are booking profits and at the same time also doing average auto averaging, that auto averaging index has outperformed 1 percentage points in last 5 years. So which means that this quarterly rebalancing is actually helping fund perform better. So now coming back to the portfolio comparison of Nifty 50 equal weight vis-a-vis Nifty 50 index. So top 5 companies in Nifty is having about 40% weight, while because we are having equal weight in case of Nifty 50 equal weight, the weight in these top 5 companies in case of equal weight index is 9.7%. Although at the time of rebalancing, which I mentioned at the end of March, June, September, and December, the weight is brought down to 2%. But because one of the company, Infosys, underperformed within top 5 companies, so that's why weight has reduced in last 1 month. But at the time of next rebalancing, the weight will be again made 2% each for all the companies. At the same time, bottom 5 companies in Nifty is having just about 2.4% weight, while bottom 17 companies aggregate weight in Nifty 50 index is 10.2%, which is less than the highest weight in the company, which is Reliance Industry in Nifty 50. So which means that bottom 17 companies on aggregate basis is getting same weight or same importance in Nifty 50 index, which is given to top company, which is Reliance Industries. While in case of equal weight index, we are giving equal importance to all 50 companies, just like in a team game wherein it is important that each member of the team performs well, because otherwise you won't be able to consistently perform well. So just like that, in case of equal weight index, we are giving equal importance to all the companies. And this equal weight index has actually outperformed broad market cap based index Nifty 50 by 200 basis points since inception. So last 25 years, it has delivered 15.6% annualized returns as compared to 13.6% for Nifty 50 index. And good part is this 2% alpha has come with lower volatility, with of 21.9% as compared to 22.5%. The reason could be because Nifty is skewed towards large companies, and any volatility in those top 10, top 5 companies actually impacts the volatility of the index as well. So because of that reason, the volatility of Nifty 50 index is much higher as compared to equal weight index. And this 2% annualized alpha or better returns has actually created a lot of wealth for the investors. So rupees 1 lakh invested 25 years back would have become 31.7 lakhs in case of equal weight vis-a-vis 20.9 lakh in case of Nifty 50 TRA. So which means you would have generated 50% higher wealth had you invested in equal weight 25 years back. So whenever you want to analyze performance of any index or any strategy, it is advisable to look at rolling returns, because point-to-point return could be impacted by either base effect or recent performance. So if we analyze the performance of this index on rolling returns basis, so for example, 1 year rolling returns basis, we have about 5,600 observations, while equal weight index has delivered 19.1% annualized return on 1 year rolling returns basis. As compared to that, Nifty 50 index has generated 16.25 years. Equal weight index has delivered 2.9% annualized returns, better as compared to Nifty 50 index. And in terms of overall 5,600 observations, 58% of the time, equal weight is performing better. Similarly, on 3, 5, and 10 year rolling return basis also, it has performed much better as compared to Nifty 50 index. And if you look at last 23 financial years, we will find that 15 out of 23 financial years, equal weight is performing better as compared to Nifty 50. So 2/3 times equal weight has performed better on financial year basis. So now let us analyze performance of these two indices in different market environments. So we have broken Nifty 50 index return in 5 different market environments. So we analyze 1 year rolling returns. So first is whenever market is falling more than 15%, so on yearly basis. So there are about 515 such instances wherein equal weight index has fallen 24%, while Nifty 50 index has fallen 27%. So which means whenever market is falling, that fall is mainly driven by large companies within Nifty 50. That is the reason why Nifty 50 index is underperforming, because larger companies within Nifty 50 may be exhibiting very high volatility in such time. And equal weight index has delivered 3% alpha on 1 year rolling returns basis whenever market is falling by more than 3%, more than 15%. Similarly, whenever market is falling 0 to 15%, equal weight index is performing 3.2% return better as compared to broad market cap based index. But whenever market is delivering 0 to 15% positive return, in that environment, Nifty 50 index is delivering 1.1% better returns as compared to equal weight index. While whenever market is rallying either 15 to 30% or more than 30%, in that environment also equal weight is performing much better. So 4 out of 5 environment, equal weight is performing better as compared to Nifty 50 index. The good part is just like stocks diversification, wherein each company is giving 2% weight in case of equal weight. So portfolio is much more diversified at stock level. Similarly, at sector level also, this particular index is much more diversified as compared to Nifty 50. Top 3 stocks weight in Nifty 50 is about 63%, while top 3 sectors weight in equal weight is about 45%. So which means it is much more diversified at both at sector level as well as stock level. So which means it is much more balanced as compared to Nifty in case of sector as well as stock selection. And in terms of valuations, at this point in time, equal weight index is available at discount to Nifty 50 index. So PE ratio, price to earning ratio of equal weight index is lower as compared to Nifty index. At the same time, price to book value ratio is also lower. So in both these valuation criteria, it is available at discount as compared to Nifty 50. At the same time, dividend yield is much higher. So which means in all these valuation parameters, it is performing better, or it is available at discount as compared to Nifty 50 index. And we have seen that whenever it is trading at discount, wherein it is available at premium as compared to Nifty 50. Just to summarize, Nifty 50 equal weight index fund is giving equal importance to all the 50 companies, just like in cricket match, wherein each player is playing a very important role. And if you are overly relying on some companies or some players, in that case, the performance could be very volatile. So because of because this particular product is very well diversified, so which means that in the longer run, it is able to perform much consistently, much better as compared to equal weight index. So it is having same constituents as Nifty 50 index. The only difference is weighing criteria is different. In case of equal weight, all the 50 companies are having equal weight, while in case of Nifty 50 index, the weight of a company is based on the free float market cap of the company. And because of that, top 10 companies are having 58% aggregate weight, while remaining 40 companies are having aggregate weight of 42%. And this particular index is rebalanced on quarterly basis. So there is active or auto profit booking for companies which have delivered better returns, while auto averaging for companies which have underperformed. And we have discussed that this auto averaging on an auto profit booking element is also helping fund perform better in the longer term. At the same time, this particular index is much more balanced because it is having lesser concentration at sector level as well as stock level. So which means that the consistency of return could be better as compared to Nifty 50 index. And as I already mentioned, there is automatically rebalance feature for this particular fund on half yearly basis. Whenever constraints are changing for Nifty 50 index, likewise in this index also the constraints are changed. So I will stop here and take any questions or feedback that you may have. Thank you. Deepak, over to you.
Thank you, Sharwan. That was an extremely lucid explanation. So friends, index investing is simple. It is effective. It has tax advantages. It avoids human biases. And above everything else, it is lower cost. And within index investing, when it comes to smart beta products, we have the advantages of both the passive investing as well as active investing. How active investing? Sharwan just explained to you. The equal weight index is balanced every quarter, and every quarter there is an auto concept of booking of profits. So for example, at the beginning of a quarter, if a particular, each of the stocks are at 2% weightage, and if in one quarter, one of the stocks runs away and becomes a weight of 3%, automatically at the end of this quarter, it will be brought back to 2% by booking a part of the profits. And as a result, as Sharwan just explained and showed some past data, it would have been hugely profitable if 25 years back we had similar product. Your investment would have been outperforming the normal Nifty index fund by margin. Sharman, we have quite a few questions. The team is selecting a few questions which you can address. So to begin with, the first question is, while the passive fund category is growing, what are the major categories of passive funds available in India for investors?
Sure. There are over 150 products available on passive side, and on unique indices, there are about 60 to 70 indices wherein passive funds are available. But the good part is, just like global markets, wherein large part of the success of passive funds comes from broad market cap based indices. So for example, in US, S&P 500, NASDAQ, these kind of funds are much more popular and bigger as compared to other smart beta strategies. Similarly, in India also, the broad market cap based indices or funds based on broad market cap based indices such as Nifty, Sensex, Nifty Next 50, these are much more popular. At the same time, size of these indices is much bigger. So for example, overall size of passive funds is about 7 lakh crore, out of which equity is about 5 lakh crore, 4.5 lakh crore. But Nifty and Sensex put together is having about 75 to 80% exposure within that. So the broadly market cap based indices are very popular. At the same time, a large part of money is going in those funds. My advice to first time investors would be people who are new to equity investing or new to mutual fund investing. They should broadly start from broad market cap based index, because these indices are popular, at the same time easily understood. So which means that one should start in broad market cap based index funds such as Nifty, Sensex or Nifty Next 50. As investors understand the nuance of some of the thematic or smart beta strategies, then they can get into those complicated products. But the good part is Nifty 50 equal weight, although it is smart beta strategy, but broadly stock selection is same as Nifty. The only difference is you are giving equal importance to all those 50 companies. And we have seen that having equal importance or equal weight in those 50 companies is actually delivering much better outcome as compared to concentrated portfolio.
Great. We have another question. In terms of investor returns perspective, what would be a right allocation between active and passive strategies? You know, Sharwan, this debate about active versus passive has been very, very long and unending. How would you say that in terms of investor returns, what should be the right combination?
So I would say that active and passive are complementing each other. It's not, they are not competing with each other. So it's an end function rather than either active or passive. So one should not view active or passive depending upon investors' investment objective and risk appetite. One can have exposure in both active and passive, because some of the product may not be available in passive, and some of the categories such as small cap, wherein small cap and mid cap strategies, wherein alpha generation ability of active management is much higher as compared to large cap. You can have a combination of active and passive. But first time investors should ideally start with broad market cap based index fund, and the core part of your portfolio should be in broad market cap based index fund, because a lot of options are available in passive category. Apart from market cap based indices, various thematic and sectoral funds are available. At the same time, we have also analyzed performance of various smart beta strategies, and we have found that having some exposure to these smart beta strategies is actually helping you generate much better outcome as compared to broad market cap based index.
So broad market-based indices like Nifty and Sensex should be part of your core portfolio. And very important, active and passive funds are not competing with each other. They're complementary to each other. Great, Shravan. While you have explained it, there is a question which has come back in terms of what is the difference between Nifty 50 index and Nifty equal weight index? Probably you would like to revisit this again, re-explain this, please.
Sure. So as we discussed with the cricket analogy, wherein in case of team game, having a balanced side plays far bigger role rather than having star-studded team, wherein if those players don't perform in a particular season, then you get impacted because of that. So similarly in investing, having equal importance to all the 50 companies, which are largest company listed on NSE, gone through different cycles, has delivered better outcome as compared to having skewed exposure towards some large companies, right? Good part is Nifty 50 equal weight index is having same exposure to same companies, just that weighing criteria is different. So both at stock level as well as sector level, this is much more balanced as compared to Nifty 50 index. So these are the broad strength of these indices. And as we also discussed, that there is a quarterly rebalancing, which is also helping this index perform better, wherein there is active profit booking for stocks which have outperformed, while companies which have underperformed, auto averaging is done in those companies. So because of all these features, equal weight is actually complementary style to Nifty 50 index, and one should have exposure to both Nifty 50 market cap weighted as well as Nifty 50 equal weight, because in different market environment, different funds could do well. So in a polarized market, Nifty 50 index could do well, because in a polarized market, large companies perform well, while in a broad-based rally, so wherein market is rallying, in those market environments, generally equal weight has performed much better.
Great, very well explained. So you also already addressed one more question, which was about quarterly rebalancing feature, as to whether this really helps. You already explained, but do you want to add something more to that?
So logically, it makes sense, because you are selling companies which are performing well, while you are buying companies which have underperformed. And within large cap companies, because these companies are very well explored by market participants, so we haven't seen very strong momentum playing out in these companies. And actually, this auto rebalancing is actually helping it perform better. As we mentioned during presentation, that we run 2 iterations, wherein we took Nifty 50 index 5 years back, and then we analyze in 2 different parameters. In first parameter, we provided equal weight 5 years back to those 50 companies, and we didn't change the weights of those companies in between. And then we analyze performance of that index vis-a-vis another index, wherein the another index also started with 2% weight, but we did quarterly rebalancing, wherein we were booking profits for companies which were outperforming, while doing auto averaging for companies which are underperforming. So the second fund, which is doing quarterly rebalancing, actually has outperformed 1%. So which means out of 2% outperformance, 1% has come from auto or quarterly rebalancing. So this quarterly rebalancing, theoretically as well as actually the fund, has delivered much better outcome as compared to not rebalancing the fund on quarterly basis.
Great. Shravan, you are answering most of the question even before I'm asking you. So the next question which I was about to ask you was, in which market scenarios equal weight outperforms Nifty 50? I guess you have answered that, but if you have anything else to add, or I go to the next question.
See, we have run the iteration wherein we have analyzed performance of equal weight vis-a-vis Nifty 50 in 5 different market environments. Whenever market is falling more than 15%, 0 to 15%. Similarly, on rallying side, we looked at 0 to 15% rally, 15 to 30% rally, and more than 30% rally. So theoretically, in a polarized market, Nifty 50 performs well. But in a broad-based rally wherein mid-cap companies are performing well, in that market environment, generally, equal weight is performing better. So whenever market is delivering phenomenal returns, in those market environment, equal weight is performing better. So in last 23 years, Nifty index has delivered more than 20% return in 8 financial years. And in all those 8 financial years, equal weight index has performed well. So which means whenever there is a wider rally in the market or greater rally in the market, in that environment, equal weight is performing well.
Great. We have a question. Should we stop investing in Nifty 50 now? I'm so convinced with what Sharvan is saying that should I stop investing in Nifty 50 and invest everything in Nifty 50 equal weight?
So having 100% exposure to either Nifty 50 or Nifty 50 equal weight is not advisable. As I mentioned earlier, in a polarized market, Nifty 50 generally performs well, while in a broader rally, equal weight performs well. Because we don't know where markets are headed in next 1-2 years. So ideally, one should have exposure to both equal weight as well as Nifty 50 index, so that you are not putting all your eggs in the same basket. So you should have exposure in both these indices, because Nifty 50 index is also having almost 30 years track record. And in 30 years track record, it has delivered double-digit return, more than 15% return. So it makes sense to have exposure to both equal weight as well as Nifty 50 index.
I absolutely agree. Do not stop your SIP if it's in Nifty 50 or Nifty Next 50 or any other fund. Please continue with those same SIP and create an additional SIP or one-time lump sum investment in Nifty 50 equal weight index fund. It gives you an added advantage, but in certain scenarios. So please do not stop your SIP. And I'm sure with the way your income is growing, you can add a couple of more SIPs and do that rather than stopping your existing SIP. The next question is, what are the risk factors in the fund? How to overcome Yes Bank kind of situation?
Sure. See, in case of Nifty 50 index, it is selecting 50 largest companies traded on NSE. So which means it is selecting companies which have gone through different cycles. One of the stock could fall, which happens in all the indices. So that risk is there in all equity products. It's not only attached to Nifty 50 index. In fact, that risk is much bigger in case of mid-cap and small-cap companies, because large companies have gone through different cycles. At the same time, their business model is much more diversified as compared to smaller companies. So this kind of financial risk is much more in case of smaller companies, because those smaller companies are having single line of business. And if because of external environment, their business model can go for a toss. So that kind of risk is there in across all products. So one should not get swayed by one company's performance in an index, because one company will have at most 2% weight in equal weight, while the weight could be higher in case of Nifty 50 index. So your exposure is very well diversified across 50 companies. One company not performing well in a particular period is not going to impact meaningfully to your overall portfolio. But we advise you to consider equal weight from medium to longer term perspective, because we saw that on 1, 3, 5 year rolling returns basis, it is performing much better, while point-to-point returns could be weaker in a particular time period. So one should approach these kind of smart beta funds from medium to longer term perspective, because in the longer run, on an average, it is performing much better. So ideal way of investing is through SIP, because you are getting rupee cost averaging if you are investing in SIP, and you are not exposed to entry point if you are entering through SIP route.
Okay, so what you're saying in different words is Nifty 50, friends, is having the 50 largest company of India in it. भारत की सबसे बड़ी 50 कंपनियां, 10, 20, 25, 30 सालों में एक आध कंपनी में प्रॉब्लम्स हो सकती है, but as Sharvan just showed you the figures, in a long period of time, overall, it does not really have a meaningful impact. And more so, Nifty 50 equal weight is diversifying the entire investment among 50 companies equally, which means even if theoretically, even if one company was to go to complete zero, you still would not lose more than 2%, right? But this kind of a scenario of a top 50 company in India going down is rare event. Even if it would have happened once or twice in last 60, 70 years, you don't see such kind of events happening regularly. So it's a fairly safe strategy to do that. Will not quarterly rebalancing result in higher expenses? Says Nagesh.
Sure. So in last 5 years, on quarterly basis, there is 5% rebalancing. So which means annualized portfolio turnover ratio is about 20% in case of equal weight. While in case of Nifty, it could be a couple of percentage points, because hardly 1 or 2 companies are getting changed in Nifty in last 5-10 year period. And the weightages of incoming and outgoing companies is generally less than 1%. So yes, the rebalancing cost is higher, but despite that, the 20% rebalancing cost, on an average rebalancing cost is about 12 to 15 basis point on annual basis. In fact, just about 20% portfolio changing on yearly basis. So which means 2-3 basis point overall expense ratio whenever you are doing the rebalancing on annual basis, while it is generating 2% alpha in the long run. So which means the rebalancing cost is fractional cost of outperformance that this particular index has generated in last 25 years.
Okay, Sharwan, your explanations are really making the expectations go through the roof. So the next question says, Nifty 50 is related to large cap. So if we compare the returns of Nifty 50 equal weight with mid cap and small cap index fund, how often does this beat even mid cap and small cap fund returns? That's for your explanation.
Right. Because equal importance is given to Nifty 50 companies, and within Nifty 50 companies are also, apart from top 10, 15 companies, some of the companies are having mid-cap characteristics because their business model could be linked to one segment of the market. So which means whenever there is a broader rally in the market, these 50 companies based on equal weight will also participate in the rally. Although in an extreme bull market, they may not perform as well as mid cap, but they will capture large part of upside that you will see in case of mid cap index. So which means you are staying invested in top 50 companies which have stood test of time, wherein they have gone through different business cycle. But at the same time, whenever there is a wider rally in the market, you are able to capture large part of the rally. Just to give you one data point. So whenever Nifty 50 index has delivered more than 20% return, in that scenario, equal weight has delivered 62% return as compared to 50% for Nifty 50 index. So which means whenever there is a wider rally in the market, at that time equal weight is capturing large part of that rally, while mid cap and small cap index could deliver much better outcome. But at the same time, volatility and risk factor in mid and small cap is also higher. So which means that on risk adjusted basis, if you evaluate, then equal weight is a good strategy.
So true. So friends, while comparing two funds, you also need to look at the risk part of it. Only comparing returns is not fair. And a comparison of a small cap fund with a large cap fund, with of course, large cap having much lesser risk, is not fair. One question is that while I know this is about Nifty 50 equal weight, in the introduction, you had mentioned about a housing index fund. I'm interested in housing index fund. Can you please tell us a little about that?
Sure. So along with Nifty 50 equal weight index, we have also launched UTI S&P BSE Housing Opportunity Fund. It's a pure play housing fund wherein we have captured companies which are getting influenced by recovery in housing sector. So housing sector goes through different cycles, and in last 20 years we have seen that it goes through different cycles wherein whenever it is in uptrend, generally uptrend lasts for 5 to 7 years period. So from 2013-14 to 2020, in that period it was going through tough time, but post-COVID housing sector has started showing very strong recovery. So post-COVID housing sector has started showing a lot of promise. So which means that if we follow longer term trend, then the rally could continue for next 3-4 years. At the same time, some of the companies in this sector, for example, real estate companies, have understood the fault that they have done in the previous up cycle, wherein in earlier cycle their balance sheet was in the sense much more bigger because they were outright buying land and then constructing projects, while in this cycle they have understood and they've gone asset light, and some of the real estate companies are actually jointly working with landowners rather than upfront buying land and then developing the project. And because of this asset light business model, their return on equity and various return parameters are much more superior as compared to earlier cycles. At the same time, as compared to other housing opportunities fund available in the market, this is pure play housing fund. So which means we are not having exposure to banks, metal sector or power sector, wherein the business model of those companies is not directly linked to housing opportunities fund. In this index, we are having about 30% exposure to cement, 20% exposure to real estate companies, 10% exposure to paint, 15-20% companies to building material companies such as tiles, sanitary ware, pipes, those kind of companies. So it's a pure play housing opportunity fund. And we believe that housing sector, because most of the government schemes, both central and state government, they are focusing in providing housing for all the citizens of the country. And we believe that this particular segment of the market will benefit from that particular approach of the government, because India has achieved self-sufficient in food and textile, as we mentioned, roti, kapda, and makan. And so while housing still remains a distant dream for a lot of Indians, so we believe that government policies at the same time, rising income level of the people will support a lot of growth for housing in the long run.
Absolutely. Agree with that. There's been a question, additional question on you mentioning about 23-year history when you looked at comparison of Nifty 50 versus Nifty 50 equal weight. Could you please repeat which fund has outperformed 15 times and which has underperformed?
Sure. So in last 23 years, equal weight index has outperformed on financial year basis 15 out of 23 years, equal weight, while 8 times Nifty 50 index has outperformed. And whenever market has delivered more than 20% return in a financial year, there are 8 such instances, and in all 8 times, equal weight index has performed better as compared to Nifty 50 index. So whenever there is a wider rally in the market, at that time, equal weight index has performed better. At the same time, whenever market is going through tough time, we saw 1 year, 3 year rolling returns. We found that whenever market is falling more than 15%, at that time also equal weight is performing better. Because whenever there is a bigger fall in the market, generally that fall is driven by large companies, larger companies within Nifty 50. And so which means that large companies within Nifty 50 are showing a lot of volatility, both in downside and upside. And in both market environment, equal weight is performing much better as compared to Nifty 50. While only when Nifty is delivering 0 to 15% return, on an average, equal weight is underperforming in that time frame.
Great. Shravan, I think we'll have to now conclude, friends. This is a very interesting offering which has come from UTI. As I mentioned in the beginning, we have been coming out regularly with innovative products. And right now, as we speak, we have come out with these 2 innovative products. Unfortunately for you, both the NFOs close on Monday, which is 5th of June. So if you have to participate in NFO, then you don't have much time. You have only tomorrow, Friday, and then the first day of the next week. Friends, these opportunities are open for you. You must discuss these opportunities with your investment advisor. Based on financial advice from them, you can decide on participating in these stories, these great opportunities which are there. As Shravan just said, in backtesting out of 23 years, every 2/3 of the times, Nifty 50 equal weight has done better than Nifty fund. So there is an opportunity for you to score and make sure that your wealth creation journey is accelerated. With these thoughts, thank you so much, Shravan, for your time and all the insight. And friends, if you have any more questions, please do raise it on the ID which is given on the chat now, and we shall try and answer all your queries. Also, please do consult your financial advisor before taking a decision. Stay happy, stay healthy. God bless you all. Thank you so much.
Thank you, everyone. Thank you, Deepak.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.